A lot of people will spend literally months trying to analyze the perfect 65-inch television to put on their wall or the next car they're gonna buy, right? That may cost $5,000 for the TV, or I don't even know what TVs are anymore. And a car may be up to $70,000 or whatever. And you're investing $100,000, $200,000 multiple times in these deals. And I see people spend an hour looking at it. You know, they hear a webinar and like, I'm in, no matter what, no questions asked, right? But they spend all this time trying to figure out the best TV to buy for their home. And so that, to me, that's skewed, and you need to switch that around. You've got to spend the time, and you got to grind it out a little bit with these kind of deals. If you're really serious about becoming a true passive investor and generating cash flow like you're talking about, and financial freedom.
Welcome to Tech Equity and Money Talk. I'm your host, Christopher Nelson, and I'm excited this week to introduce you to Hans Box. Hans Box is the founder and owner of Box Wilson Equity Group. They have 90 million of assets under management. And Hans is also an LP in 70 different deals as well, a limited partner. He has a career in real estate, and he was also in asset management. And he's here today to talk about due diligence. Welcome, Hans.
Thanks for having me, and looking forward to it.
My pleasure. So let's talk about worst case scenario, right? Let's talk about the fact have you had a personal experience, or have you heard of a firsthand experience of somebody who, because of lack of due diligence, led to, a bad investment?
Sure. So yes, I've had it. And it actually is what got me started in my investing journey as a sponsor with Box Wilson Equity, and where we started raising money with our investors. My very first deal I got into, I was with a PricewaterhouseCoopers CPA background, that kind of thing. Got into real estate, made an investment into a passive multifamily deal back around 2009 or so. And it's a bit of a long story, but myself and another limited partner ended up taking over that deal. Were voted in by the other limited partners to take over the deal because the deal wasn't going well. And we were the two vocal limited partners that started, speaking up. We got voted in to take over that deal, hire a new management company, and try to turn it around because the sponsor wasn't doing his job.
Right.
So that other limited partner that I teamed up with at that time is now my business partner at Box Wilson Equity. He's the Wilson, I'm the Box. So
wow.
Yeah. So it was that deal that actually got me. That was one of my first investments ever, and it's when I didn't know how to do due diligence. So I didn't do a good job of due diligence at that time. I was coming out of a professional services firm, but it's completely different.
Sure.
Doing that, even though I was a CPA, that has nothing to do with how to really do true due diligence on a multifamily or commercial real estate deal.
That is a phenomenal segue into this whole, overview of the process that we want to get into today. Is, many professionals, and I'm witnessing this today coming from technology, is they're very proficient at their jobs. They've become experts at their jobs. They get excited about getting into private equity. They see the income potential, they see the equity growth, the tax advantages. But there is truly a different skill of due diligence that you need to understand to be successful. And so what are some of the core components of due diligence that you think it's fundamental that people understand?
Well, I mean, a lot of the skills you just talked about are transferable, but you have to learn them, right? So an engineer or accountant or somebody that is deep into details and analytics is probably going to be pretty good at due diligence if they apply themselves and learn what you have to do to understand a deal. I think the key parts of doing due diligence on a deal are number one is vetting the sponsor. It's all about the jockey, as you probably heard that term. It's all about the jockey. It's more important than the horse. It's really about that person you're investing with, or persons that you're investing with, the sponsor team. Because a good sponsor can turn a mediocre deal into a home run, and a home run deal can be run into the ground by a bad sponsor. So you've got to learn how to vet the sponsor, and then you have to learn how to read a P&L. You have to learn how to be able to look at a deal and understand if there's a value add component.
Right.
You have to be able to learn how to look at debt and different types of compensation structures that sponsors may have. So it's all about, to me, it's all about the skills are there. Most professionals have the skills to do this. It's not rocket science. It's more about following a process and thinking through the details of the certain items that you've got to spend time on. You got to treat this, to me, if you're investing $100,000 in a deal, you really need to treat this as your second job. If you have a W-2 now, this should be your second job.
I agree. And I know you've invested in 70 deals as a limited partner and have had the opportunity to hone this and also deploying other people's capital as well. So let's start with the operator. Let's start with the jockey. And I love the analogy, right? Is the asset is this beautiful animal, this horse that we want to win the race, be successful, achieve the returns, but it is dependent on the jockey. Right off the bat, what are some red flags that you look for when you're starting to vet an operator that say, I'm gonna actually pass on this because I've seen these few things?
Sure, and I think a good way to start this off about an operator is a quote what is a gold mine? A gold mine is a liar standing next to a hole in the ground. So basically the idea being is I usually start out not assuming somebody's not telling me the truth, but I start out with doubts, and I start out with, you've got to prove to me that this is a good deal. So, red flags to me are, number one, lack of being transparent. Right. I think that no matter whether you're investing $25,000 or $500,000 into a deal, you should get all your questions answered, and they shouldn't act arrogant or put off that you ask questions, even if you're not investing a lot of money. Right. Because that little bit of money that you're investing now could turn into millions later. I've seen it happen with my own investors who invested a little bit now and a ton later. But it speaks to who they are as a person. I have invested in deals where the fund was a $100 million fund and I was maybe putting in $100,000. And the guy didn't need my money. And he spent an hour with me on the phone talking me through my questions because it was their first go round. So I had quite a few questions for them. And that sold me for life on them because he was super transparent and he knew what he was talking about. So the number one thing, red flag with me, is lack of transparency.
Yes.
When I look at a business plan, I can usually tell pretty quickly how sophisticated they are, right?
Yes.
In the way they present the deal. Whether they make sure that there's a clear value add component to the deal, and we may get into that when we talk about the deal itself. But
sure.
It's really anything that's super salesy to me is an immediate put off.
Right.
I will a salesy deck or a salesy video or webinar, I'm immediately pretty much, if not a red flag, I'm a bright yellow flag, right? And it's just not, good sponsors I've noticed over the years, and like you said, I'm over 70 plus deals. Not including my own. And usually the salesy ones are the ones that end up being bad. I have noticed it in the past. Good sponsors don't need to sell themselves. They have a track record they present. You can see the track record, and then and when they present the deal, and they present it in the right way, in a sophisticated way, in a way that shows the details of the deal and also shows the value add components of the deal to the investor in a very clear way that's not convoluted. There's no financial engineering. It's just, here's what we're going to do. Here's why we can do it. That's all you need. If it's salesy, I would immediately have a red flag. So really, those are the two big things that jump out at me without,
So there's two questions I want to ask here. Yep. I think while we're on this topic of salesy, what to you, smells like salesy? Is it leading too much with returns and not truly the substance of the business plan? Is it too many glossy photos and talking about, I want to try and dig into specifics so that people, like I'm imagining, sure. Somebody's flipping through their first PPM. And I know for myself that if I'm going through an investor summary and I'm seeing 3 pages on the return profiles and what it's going to present to me, and it takes me a while to really understand what's the asset, where is it located, what's the value add plan, how those dollars really going to realize. I feel like that's a little salesy.
Very much so. Like for instance, there's a deck that I looked at a while back, and they had a matrix on one of their pages where they said, if you invest with XYZ company, 100,000 in the next 10 years, here's your value. And it was trying to say, okay, we're shooting for X amount of returns. And then they were doubling their money and showing this to somebody that wasn't sophisticated. They'd be like, oh my God, I could make this amount of money investing with them, and it was complete. The whole thing was basically made up. They don't necessarily have a track record. They're just projecting what they think they can do in the future, on deals that they don't even own yet. And so something like that, or something like where red hot deal in the subject line to the email. You're getting tons of email blasts. Any sponsor where I get multiple email blasts on, that I'm done. Right. It's just not. It's not the true institutional sponsors, the good sponsors. They don't need to market because they have returns and they get referrals, right?
Right.
And I totally understand new sponsors needing to raise money to get investors, but you should start small. Create a track record. Go do a small deal where you don't need to market to a ton of people and just raise a little bit of money. Raise your $500,000. Go do a good deal. Show a track record, and then use that to slowly grow. You can't just jump into the deep end of the pool as a sponsor. And a lot of these people are, because being a GP has become, the thing to do, right?
Well, and to me, that's a huge red flag, is lack of experience. And 100%. I think that plenty of people have seen in the last few years that they've had somebody who had some success in a business over here who thought, I'm going to transfer these skills and now I'm going to become an apartment level GP. They went through a course, they raised a ton of money, and some of these deals are imploding.
Yep.
And so let's talk about what do you look for experience? Like, okay, now we've seen some red flags. Inexperience is one, but if you are looking for that experienced jockey who can get the horse where you want it to go, what are things that make sense to you? Yeah.
So number one, I want to see a page or two, whatever it takes, showing their track record in a very clear, concise manner. Don't show me you bought a deal for this, and then and basically you distributed X amount of dollars over the course of the deal. That means nothing. I want to know what your MOIC is, your multiple on invested capital. I want to know what your IRR was, and I want to know what these are for the investors themselves. Were you a direct GP? Did you have control of the deal? Were you a money raiser? Were you brought money to somebody else's deal and you didn't really produce the return? Nothing wrong with partnering with other people, but you need to show that in the track record, right? One thing that I've seen a lot of recently, and this is because of the run-up, especially in multifamily, but in other asset classes as well, because of the run-up in pricing, i.e. cap rates being so low, is that you will see sponsors that have been in the game for 3-4 years at max, right? And they have average IRR of 45%, right? Well, they bought a deal in 2019, sold it in 2021. Bought a deal in 2020, sold it in 2022, right? So they're flipping deals.
Right.
So they're getting very high IRRs because you sell basically IRRs, the quicker you sell a deal, if you make a decent return, your IRR is going to shoot through the roof, right? Right. So you can have a really high IRR and maybe not that high of a MOIC. Or, more importantly, you rode cap rate compression is what you did.
That's right.
And what I want to see is, okay, that's great. You got a 45% IRR. That's wonderful. I would love to get that, right? But I want to know, what was your projected NOI, and did you hit your projected NOI on your value add?
Right.
Versus, did cap rates compress after you bought the deal and you just sold it to the next guy?
And so to translate, what Hans is really saying is, to make sure that you're not just looking at a sponsor that's showing tailwinds are helping them win in the market is now, so we've seen the stats that say the deal exited well. Now let's go look at the business plan say, were you executing to the business plan, or was it truly just the market tailwinds that allowed you to get those great returns?
Or even simpler, did you do what you said you were going to do with regards to the value add component?
Right. Right, because that's so critical. And I think, so then moving on from the operator, the next thing is then really looking at the pro forma, right? And I think this is something, actually, it was interesting for me, what transferred for me from corporate to private equity was I was on the buy side of SaaS. Mm-hmm. So I worked in IT organizations and software companies, and we bought Salesforce.com, we bought Workday, we bought a lot of this software. And what comes with those softwares? These contracts. that are just so thick, and you start understanding, okay, what are the portions of the contract that are just wrote, like I need to read through them once and understand these sections, but then where are the sections where there's the meat of the deal?
That's
like
right.
it's really being negotiated. And so that helped me map over to PPMs, or private placement memorandums, because that, after the sponsor is really, then that's the contract that you're signing to make the investment.
That's right. That's right. So, I mean, there's so many things you need to look at when you're looking at the deal. You're asking, like, what do you look at in the deal itself, right?
That's right.
And so the number one overarching thing that if anybody wants to take away from this particular podcast is, when you invest in a commercial real estate deal or a commercial real estate syndication, there needs to be a value add component of the deal. There are a lot of people that will buy deals and say, this is a yield play. We're buying it and we're just going to get a coupon payment, or et cetera. But there's basically what that means is you are buying a deal at market and you're not adding value because there's no distress in the deal, which is what you just told me, right? There's no distress in the deal. So if the market goes down, basically you're buying it here, you get your amount of equities here. If the market goes down, guess who loses money? Equity, right?
Right.
But if you buy it here because it's distressed and you're able to force value into the deal, whether that takes a year or 2 or 3 years, now the value of the deal is here. So if the market, things out of your control drop, you have a gap. So basically you have a margin of safety for your equity, because your equity is the first thing that goes if you lose money. So there has to be a value add component or a margin of safety, just like Warren Buffett talks about. There needs to be a margin of safety for your money. So what I want to see when I look at a business plan from a sponsor is, I want it to be extremely clear to me as an investor, I'm looking as an LP, what the value add strategy is. It should be able to say that in 2 or 3 sentences. And if you've read a whole business plan and you're not clear what the value add strategy is yet, and then you go ask a sponsor and they can't articulate that to you in a very clear manner, in a way that somebody that's not, a professional real estate investor can understand, then that immediately gives me, red flag vibes.
Right.
So it's all about the value add strategy. There has to be a value add strategy. And then you have to be able to understand, when they describe it to you, can they prove it out? Can they actually get, if the value add strategy is to raise rents by 15%, good, that's great. But prove to me why you can raise rents to 15%, and that the business plan needs to show that. You need to show rent comps. You need to show, why are we below market? What are we going to do to the deal differently than the prior owner did, and why can we raise rents and they couldn't?
That's right.
Things like that. So it's all about the value. The number one thing is about the value add strategy, and so that ties into who the sponsor is too.
So how would you then, if somebody brought you a deal and they called it, let's say, a yield or yield plus, and meaning that they weren't going to do any value add or a little, but they were buying it distressed, how would you approach that?
Well, I mean, without more information, hard to answer. But number one, buying a yield play and they're buying it distressed, but there's no value add. Those all go against each other.
Got it.
Right. Those don't make any sense. Right. So if there is no distress, then there is no value add. And when I say distress, you can look at it a million ways. You can say it's dilapidated, needs rehab, things like that. It's low occupancy. But in my mind, distress also means you're not at market rent. You're making below market revenue.
Interesting.
Right? So there needs to be, and part of it's definitions, but as an LP, you have to be able to understand where the sponsor is adding value to the deal. That's essentially what you have to look at.
And I like that concept, and thank you for walking. I wasn't too descriptive. I was trying to ask something open-ended to understand a little bit more of your strategy and philosophy, which I'm really enjoying this conversation, because even if, and I was thinking I was imagining that, again, I'm a tech employee. I'm looking at a new opportunity right now, and especially in this market, I think the word distressed is being used a lot. And so I'm trying to sort of unwind that, and distress can be meaning bad or heavy debt load. They purchased very high. And so I think, though, to your point, even if you're replacing the debt, underneath it, there has to be a functioning asset that has to have core operations, that's hitting market rents, that has a strategy to grow rents, and has a strategy to make sure that you're keeping ahead of the depreciation of the building, ultimately, at a bare minimum.
Exactly. And I mean, in today's market, there may be a few opportunities where equity is forced to sell. Right. Or there's rescue equity coming in or things like that, where the property may actually be at market rents, okay? But the distress would be they paid too much money for the deal.
Right.
And they have, a gun at their head because debt maturity is coming up and they've got to get out of the deal.
Right.
And in that case, maybe they can't raise rents. But if you're buying the deal 40% cheaper than what they paid for it, then there may be an immediate value. The immediate value add is you're getting cash on cash returns day one, right? Right. Because another thing to think about is cash on cash returns. Eventually, whatever deal that you're investing in commercial real estate, in my opinion, unless it's, there's some industrial deals where you're not going to have a lot of cash flow because you turn over the leases and then immediately want to sell it. Right. But for the most part, you want cash flow. The deal, once you've implemented your value add strategy, needs to have cash flow. The more cash flow there is, the higher percentage to the investors, whether it's 5, 6, 7, 8, 9, 10%, the more margin of safety there is, because that means basically free cash flow to protect yourself, right? To be able to pay debt. And then, so the higher the cash flow, the safer the deal typically.
And I actually love those deals as well, because then to me, that's the true benefit of commercial real estate. That's because you're getting the cash flow, you're getting the equity, the appreciation potential, or forced appreciation from a great business plan, and then the depreciation. That's the trifecta.
Yeah, I mean, that's exactly right. And where you can get part of your, maybe half your return in cash flow on an annual basis, once they've implemented the value add. And I want everyone to know that if you hear somebody saying they got a deep value add and they're going to have cash flow of 8% day one, that I'm not saying that's impossible, but you're right. There's a big question mark there. And I'm like, okay, how, right? Because the whole point of a value add is that you have to add the value first before you get the cash flow. So usually if there is if you're buying a deal that has value add or has distress, then you may need a year, 2, or even 3 years to turn the deal around, to reposition the deal as a sponsor before you start producing the income that can produce the cash flow for the investors.
And there's an expectation from the investors that it works that way too. Again, the savvy, experienced investors understand that there's going to need to be an investment to get the value to then start returning the cash flow.
That's right.
And that's important that I think people listening here understand that, because getting those returns on day one generally means that somebody is over raising capital, and that means dilution to the deal, and it's not going to be as valuable on the back end. It feels good. Sure, it feels great to get those returns happening, but the reality is there's a lot of over dilution there.
I mean, I'll touch on that because you brought it up, but sure. It's one of the things I look for in the pro forma is I want to see your P&L, and I want to see the cash. Like, I literally want to understand the profit and loss all the way down to NOI. Then I want to see the debt payments below NOI, and then I want to see whatever, corporate like asset management payments are until you get to true cash flow. And then I want to look at that cash flow that they're showing in the P&L and then compare that to what they're promising investors. And this is how you do it. You can figure out whether somebody is raising money to basically pay it back to you by doing this. You look at the actual cash flow, the numbers on the deal, and you can figure out, okay, they're going to generate enough cash flow to pay me, say, a 7% preferred return day one, or are they just raising enough money and they're returning it to me?
Right.
I am immediately red flagging out on any sponsor that raises money to pay it back to me. Because that to me is it's false. It's basically saying I'm going to overraise money and just pay you back your own money, so it looks like I'm producing cash flow when I'm not.
Right. Yeah. And to everybody listening, what that does is that adds risk to the deal, because again, what I think Hans is saying is a good business plan that shows you how they're going to generate cash flow from income through operating expenses, non-operating expenses, in that direct line. That's going to be a much better investment to have in your portfolio than something that is just has a lot of cash flow and is paying it back to you.
Yeah, I mean, and you're basically, like you said, you're getting diluted.
That's right.
They're raising money, your own money, to pay it back to you, and that means your returns are getting diluted because you're investing too much money into the deal, only to have them return it to you. So that's why it's imperative that you understand as an LP how to read a P&L.
Yeah.
You've got to learn. I mean, if anyone listening to this podcast and they're going to put 50 to 100,000 or more money into a commercial real estate syndication, if you're not patient enough and don't have enough diligence to learn how to read a P&L, you should not be investing like this. You need to hand your money to a wealth advisor, let them, put it in mutual funds and let you diversify, right? You've got to learn how to basically, just like a lot of people that probably listen to this podcast, they're tech executives, they work in tech, they run departments within tech companies, right? So they know how to read P&Ls because they run their own departments, they run their own budgets. Same idea. You just got to be able to do this on a bigger scale.
That's right. In understanding, and the reality is getting to know the different line items. It's not complicated. It just takes some time to understand, being able to ask some questions. And in fact, I like you. I mean, one of the things for myself to make the transition into private equity is, I read this book by Frank Gallianelli. I don't know if you've ever read it. It's called What Every Real Estate Investor Needs to Know About Cash Flow.
Okay.
And it's a math book.
Okay.
And it's like, I loved it because he just went into all of the underwriting around all the different assets class, everything starts with single family homes to multifamily to industrial, triple net, and you can go to the online and get the spreadsheets. And once you understand that and you see how the P&L flows, it's relatively straightforward. Then I think the next evolution in your due diligence is then saying, where are they getting their assumptions? Where are they getting the data that's going to drive rent growth?
Right. Because anybody can have an Excel spreadsheet and hit a home run, right? I can take an Excel spreadsheet, make 2 tweaks to a deal, and take it from a 10 IRR to a 20 IRR. And somebody that's not sophisticated could never figure it out, right?
Right.
So you have to be able to actually ask the right question. There's certain things that you want to know, like cap rates. If they're buying the deal at a 5 cap, but they're just, they're underwriting to sell it at a 4 cap, red flag immediately, right? Cap rates should typically should expand.
That's right.
When you sell the deal 5 to 10 years later, because that's more conservative. As cap rates go up, prices go down. It's inverse relationship. So those are the kind of things, and we don't have time to get into the details of cap rates and how they're calculated and all that, but it's imperative that you do spend the time to learn this. This is why I said it needs to be, if you're really going to be serious about this, it needs to be a kind of a second job for you.
It does. And I think once you get to the learning, once you get through that phase, being able to then do the due diligence and see that, it gets quicker. It's not.
But the first 2 or 3 years, you have to actually put in the reps, just like you did. You're an expert in some area of tech, or you're a doctor or something like that. You put in the reps there. You got to put in some reps before you can start looking at deals like we do. I can look at a business plan and probably in 10 minutes tell you whether or not I really want to dive into it or not, right? So I can move a lot of deals off my desk pretty quickly because of certain red flags that we've spoken about already.
That's right.
And you just get a feel for it, just like you do in any other line of business.
And I was going to take people from that next step of, analyzing the P&L to then understanding where the assumptions come from.
Yep.
So understanding where they're getting rent growth, where they're getting expense increases, and a lot of these cap rates, a lot of these different factors, and it comes down to probably a list of 9 or 10 key assumptions, just generally speaking. Mm-hmm. And if you understand what those are, and then you're able to then ask them where they source that data from. To me, the red flag is then if it comes from an in-house source and they're not running a multilytics, as we know, that the origin team is, I'm suspect. I'm like, okay, where did this come from? Because what you'll find is you want to find sponsors that are bringing valid third-party data to their models that then they can't influence or impact, to your point, that are then supporting their business plan.
100%, and that should be in their business plan, by the way.
Right.
So if you're going to say you're going to raise rents 10% because we're under market by 10% on rents, then I want to see the comps, and I want to see a comp study. In fact, I just looked at a deal with a very advanced group, actually, that was disappointing to see, where they really couldn't provide me, I asked for, they were going to raise rents X amount, I don't remember the numbers, and, they gave me generalities of why, right? But I was like, well, didn't you all do a comp study? So I want to see, I don't want to just see the CoStar report that you pulled, right? That's great that you use CoStar, although I will say there are other better analytical tools than CoStar. But my point being is they just handed me the CoStar report and then expected me to basically extract how they came to their
interesting
rent increases. And I'm like, no. This is part of the reason that I can, vet sponsors pretty quickly is they should take that and put it on a page or 2 pages or 3 pages, whatever it is in the business plan, and walk me through like I'm not as sophisticated, why you're going to be able to increase rent. Show me the comps, show me a scatter graph of the 1 bedrooms and 2 bedrooms and where this deal is versus the deals that are above it. Are they same vintage, meaning the same age or close to the same age range, things like that. So I want to basically have it lined out for me as a sponsor, as an investor to see, okay, that makes sense. They said they could raise rents 10%. Then they walked me through A, B, C, D, why they could do it. They showed me the comps. They showed me the source, like you said.
Right.
And I'm like, okay, that makes sense. Obviously, I'm not going to drive to XYZ city and do a on-the-ground market study, right? Unless I'm investing $100 million bucks or something. But usually it's, doing it this way will probably 90% of the time you're gonna be able to validate did they actually do the work.
That's right.
And they'll line it out. And if it's very clear in the business plan and it makes logical sense to you and they provide the sources, usually you're pretty good there. Another thing I want to talk about there, you brought up on assumptions.
Yeah.
That popped in my head. And this is kind of related, is